But when we look at the fall, the challenges, particularly this idea that politicians in Washington are delaying stimulus. Stimulus is an absolute necessity for the U.S. economy headed into a fall that, whether you think about announcements from schools, plans for businesses, or, near and dear to the hearts of a lot of people, college football leagues delaying their seasons, there's going to be difficulty in reopening the economy, and you've got to have that stimulus.
Yeah, and you would think a lot of investors at this point are just banking on the fact that they assume something will get done despite all this bickering. But we know what they say about assumptions. But putting that aside, it does challenge this rotation that's going on, right? Because there is also this debate over whether or not tech leadership has had its day and it's time to put more money into value stocks, look away from momentum for the time being. But how does the stimulus uncertainty play into that? And of course, the COVID case uncertainty, because that's something the Fed continues to flag their own concerns on.
That's absolutely right. So from our point of view, we think longer run, when you look later in this year and into 2021, as the economic recovery, in our view, finds firmer footing, and then you have enough time to where there's some sort of medical solution, not necessarily the solution, but certainly allowing a faster reopening in 2021. We think value will reassert itself, but at this point, with coming into the fall, with COVID cases potentially having the opportunity to spike as you have reopens, and this stimulus delay, the case for value is much more selective given the run it's had, certainly over the last 3 or 4 weeks.
Julian, I'm curious to understand how the markets are pricing in the election risk. And you're talking about how fear of U.S. presidential election outcome is well priced into the options market, where we, of course, work with strikes on the upside as well as the downside. So could you define a range that the market is playing with in and around that risk?
Sure. So, well, if you look at it, basically, and again, we have to understand that the VIX itself at 22 is elevated relative to history. But when you look at options to hedge over November and actually into January and February, under the assumption that a closely contested election may have difficulty, like we had in the year 2000, in determining a winner, the market is hedged and expecting, probably somewhere in the range of a 10% move in either direction. And we would make the case, and that's over, not the next day, but, over several days. But we would make the case that if you look at the past, is particularly the greatest fear is either of a Republican sweep or what the polls are more saying is more likely a Democratic sweep. But actually, if you have one party or the other taking full control of Washington, stocks tend to do better the next year.